Richard, and today we're going to be looking at how to deal with the deferred tax on temporary differences arising from accounting provisions. For instance, items such as provision for leave pay. So, going to keep this nice and simple. Let's say for the current year we have an accounting provision for leave pay. So the current year provision so at the end of the current year, we provide for, let's say, 100,000 Rand worth of provision for leave pay. So we're going to raise 100,000, credit the provision, and debit the expense, whether it be salaries, of 100,000. So that's a P&L, and that's a statement of financial position account. But what about last year's provision? Well, last year's provision we're going to reverse out in the current year because we're only going to be worried about the movement and the final closing balance. So this year we're going to reverse out prior year. So the prior year balance, we're now going to go debit provision and credit the related expense. Let's say for interest's sake that it was 90,000 last year. Okay, so for an accounting purpose, let's assume that the movement is going to result in a net movement of an expense of 100 minus the 90. Okay, now in most tax legislation areas, the provision for leave pay is not recognized or deductible in the same period for tax as it is in for accounting. So most tax authorities will say, well, you can deduct your leave pay expense when you pay employees out for leave pay. So that's obviously going to give rise to a nice temporary difference on which we will need to account for deferred tax. So in our current tax computation, let's have a look at it as follows. So my current tax comp, as always, we start off with a nice profit before tax. I haven't given to you, so you're just going to go XXX. Then my movements in temporary differences from normal temporary differences. You'll see later on when we do capital gains why I do that. You're going to reverse out your accounting provision. You can do the net effect. I prefer to split it up between the current year and the prior year effect. So in the current year, if we look back at that journal, what did we do? We went debit the expense. The tax authority is going to say, no, that's not a valid deduction. It'll only be deductible if paid out. And in this year, that was not paid out. So that 100,000 expense, you're going to add back to reverse out the effect from profit before tax. The prior year, well, the prior year we're going to assume has been paid. And it comes out in the wash quite nicely. So the prior year I will deduct as my expense, as my tax expense. Please take note, the difference there is I'm adding back the 10,000 expense from the provision in the current year. So those two added together land up with a positive 10,000. That positive 10,000 movement in temporary differences, we've got to ask ourselves, is it deductible or taxable? Well, if it's added to taxable income this year, in the future it will reverse out as a deduction. So, therefore it is a deductible temporary difference. So that's a deductible temporary difference movement. And after that you would then add up and get your taxable income. Ignoring things like tax losses, etc. here. So taxable income, we don't know what that full figure is. So the next thing you've got to ask yourself is, what does this look like on the statement of financial position approach? So my deferred tax balance calc. So my statement of financial position, or we can call it the balance calc of deferred tax. Okay, how does that always start off? You have the following headings: carrying amount, tax base, temporary difference, and the temporary difference times by the tax rate of 28% will give me my deferred tax, DT. I need to work out my opening balance of the provision. Opening balance of the provision had a carrying amount of 90,000. Remember, the tax base of a liability is equal to what? The tax base of a liability is equal to the carrying amount minus the future tax deductions. Here, the carrying amount was 90,000. The future tax deductions, well, that 90,000 will only be deductible for tax purposes in the future when it's actually paid out. So minus 90,000 future tax deduction gives me a tax base of 0. So tax base is 0. Temporary differences, 90,000. And that is a future tax deduction. So deferred tax on 90,000 is 25,200. Because it was a deductible temporary difference balance, that means this is a deferred tax asset. Closing balance signed off. Now, sorry, that was the opening balance. The closing balance for this provision for leave pay, well, that has now jumped to a liability of 100,000. Tax base, for the same reason as last year, is 0. Temporary difference now is 100,000 deductible temporary difference balance. Deferred tax on that, 28,000 deferred tax asset. What am I worried about? The movement. So what happened? The 28,000 minus the 25,200. So 28,000 minus 25,200 equals a 2,800. Let's think about this. It's a 2,800 increase in the asset. How do I increase an asset? I debit deferred tax financial position. And here I'm going to credit deferred tax profit and loss with the 2,800, decreasing the expense. And that, ladies and gentlemen, is my deferred tax movement for the year. Just to make sure I've got this figure right, let's go back to the current tax computation and do the proof. So that 10,000 times by 28%, remember it was a deductible temporary difference, so debit deferred tax, financial position, 2,800, credit deferred tax, profit and loss, 2,800. So my proof works out perfectly, exactly the same. So you'll need to filter that through to your notes. Let's just do the one note. So the notes to the financial statements. There's no tax reconciliation required for this item because the current tax and the deferred tax perfectly reconcile at 28%. But I will have to do the income tax expense and the major components. So income tax expense. We know that that has to have a major components. Of tax expense, and you're going to split that up between current tax, which here you don't know because I didn't give you all the information, as well as deferred tax expense. So the deferred tax, I'm going to have my movement in temporary differences normal and the tax effect thereon. If I go back and have a look at my journal quickly, what did I do? In my journal, I credited deferred tax profit and loss. A credit to a deferred tax expense account, well, that means I have a negative $2,800 on my deferred tax expense. Sum it up and you'll get your total tax expense. Great, I hope that's helped. We're next going to do a short temporary difference calculation for income received in advance, prepaid expenses, and allowance for credit losses.